This is Fin 322 Assessment 3 presentation. Our group member includes Tan Jing Wei, Ong Kim Hong, Lim Jun Sen, and I am Jonathan Toh Kai Jun. In this report, we are using net present value approach to analyze in Energy Fuel Pty Ltd. NPV is a financial analytic technique often used to determine the viability of undertaking the project or a business. It is also the difference between the present value of future cash flow and the initial investment. As such a business grows, it must make critical decisions that require significant financial expenditure. Every corporation should make extremely sensible selection about business development and investment. In this kind of instance, the organization will consult capital budgeting tools, one of the most often used NPV methods, to choose the most advantageous investment. The advantage of using NPV approach throughout this project is because of time value of money. The net present value approach is a tool for determining the profitability of a specific project. As a result, NPV is a complete tool that considers all factors of the project. Moreover, the value of investment, which means the net present value approach not just to determine whether or not a project will be lucrative, but it also calculates the overall profit value. There are numerous of limitations using NPV approach as a tool. The main limitation is about discounting rate, which means the primary limitation of net present value is that the rate of return must always be calculated. When a greater rate of return is expected, it can result in a misleading negative NPV. Alternatively, when a lower rate of return is expected, this could outcome in a false of the project and as a direct consequences to incorrect decision making. For cash flow, the NPV of a project is calculated using just for incremental cash flow. This cash flow reflects changes in the firm cash flow directly as a result of accepting the project. The following table summarizes the early cash flow for Energy Fuel. The purchase required an immediate cash outflow of 32 million. The firm realized a cash inflow when the machine is sold in at its salvage value in year 10. Tax on each cash inflow are incurred when the asset is sold. The firm realized 50,000 as a cash inflow as capital is recovered from the sale of petrol. The sale of the old and renovated barges generates a cash inflow of 1.92 million as 20% of the original cost of the existing barges are recognized at year 0 if the project is undertaken. Cash outflow of 120,000 at year 0 for redundancy payout due to retrenchment of 2 captain and 2 maintenance workers required. For the revenue for year 1 and year 2 and year 3 is at 16,800,000 and year 4, year 5 remain at 22,800,000. For year 6 until year 10, the revenue is at 28,800,000. The operating expenditure includes safe insurance and safe wages. The operating expenditure for year 1 until year 10 is 242,000. Depreciation of new and existing barges is then calculated in order to determine the deduction from taxable income. As a result, the 10-year straight line technique is used to calculate depreciation, resulting in an annual depreciation of 3.2 million. This is not, however, the net depreciation reported between year 1 until year 5, since there is a variation owing to the residual depreciation of old barges deducted from the new barges. After year 5, depreciation stays consistent since only new barges are taken into consideration. When the barges reach the end of its useful life, the assets are sold against their salvage value, and tax are paid on difference between the asset sales price and book value. In year 10, the salvage value and sale of equipment are computed as a cash outflow because we must account for the lost sale of the current barges but the sale of new barges is a cash inflow in year 10. The net present value of a project is computed by adding the present value of all future anticipated cash flow from the new project and subtracting the present value of all future expected cash flow from the existing project. The NPV of the project is calculated by adding the original investment in year 0 to the increment cash flow in year 1 until year 10 and discounting by the actual needed rate of return by 8.78%. The overall net present value of the project is 80,933,390. and 390. According to the decision criterion, if the incremental net present value is more than 0, the new project should be approved. In this case, the business should accept the project since it has positive net present value, meaning that the new venture would increase the company profit. Additionally, the project IRR exceeds the acceptable rate of return by 8.78%, signaling that the new project should be approved. For sensitivity analysis, when the assumption of demand for light diesel and heavy diesel are 0.8 million liters and 9.6 million liters respectively, then the NPV should be 80,933,390. and 390. In fact, the NPV for assumption of diesel is lower than actual demand originally. Through comparing the show that original demand changes of 200,000 liters and assumption demand changes of 400,000 liters, hence the NPV is 5,443,313. Through this case, we can determine the sensitivity of NPV for 1 liter of changes. If the demand of diesel changes by 1, the NPV will be changes by $36.29 if the demand of diesel have any changes. When the assumption of sales margin of fuel is $1.92, then the NPV should be 80,933,390. and 390. After changes in sales margin from original sales margin, it changes of negative $0.08, then the NPV will be negative 5,443,313. The percentage changes in NPV for every 4% changes in original sales margin is 6.3018%. In this case, we can determine the sensitivity of NPV if sales margin is changes by every $1. Then the NPV will also be changes by negative 185,799,930. When the assumption of salvage value is 11%, then NPV will be at 85,990,516. After the changes of negative 4%, NPV is negative 386,187. The percentage changes in NPV for every 4% changes in salvage value is negative 0.4471%. In this, we can determine that the sensitivity of NPV if every $1 changes in salvage value, then the NPV will also be changes by $1.21 also. That's all for the assessment presentation.